A simple security update, the kind that usually causes barely a ripple of recognition, instead triggered a worldwide tsunami of technological breakdown. Airport information panels turned to blue screens of death in the US, red in France. Worldwide, more than 4,000 flights cancelled. Huge queues built up from Singapore to Spain, from Delhi to Dubai. Breaking news, itself broken at source. Crucial health systems like the NHS app infected with the same digital disease. It's hit transport, with air passengers and their luggage having to be manually processed, delaying flights. Trains have also been affected. It's spread to payroll systems and card payments, Waitrose among the big retailers to be hit by the outage.
With CrowdStrike, you get AI-powered threat protection.
The source of this crisis, the very software designed to prevent one. CrowdStrike's Falcon system is on servers and computers around the world and updates regularly to keep ahead of cyber threats. The CEO has said he's deeply sorry that this update contained a bug, more horror movie than Western, with the call coming from inside the house.
CrowdStrike. We stop breaches.
Coming up today, the largest IT outage in history, sending stocks lower, and chaos around the world. Where to from here? Bond yields bounce back. Bitcoin jumps. Will Biden outlast the lettuce? And the little stock that Nvidia just invested in. Let's go, guys. And welcome back, guys, the Daily Market Review on this most interesting finish to yet another interesting week in financial markets. With S&P 500 putting in its biggest down week we've seen in quite a little while. With my S&P 500 oscillator almost getting into oversold conditions already, in which it'll probably find it maybe somewhere around 54.70 on the S&P. Guess we could look for some support around this area here. However, for now, it's still a shallow pullback. We're currently only down about a bit less than 3% off highs. Back in April, we had about a 6% pullback. If we got that again, that'll take us down to about 53.20 on the S&P 500, and we can see the market colors definitely changed up the front. All indices and most sectors underneath their 5-day moving average, except a little bit of a defensive rotation into staples and utilities. We've got some strength in Bitcoin, and of course volatility and bond yields perking up a little bit these last couple of days as well. There's a look at the 5-day relative performance of the 11 S&P stock sectors out there. You can see tech really breaking away. Earlier this week, and down 6% over the last 5 trading days. Holding up the best is energy, REITs, and staples, with financials not too far behind as well. S&P 500 still a little bit above its 50-day VWAP. Magnificent 7 sitting right at its 50-day. Nasdaq a bit below, still well above the Dow Jones Industrial, and even with that pullback in the Russell 2000, it's still sitting at technically overbought levels here. After it had a huge run-up to start the week, we are getting a little bit of a pullback here. Breadth overall still holding up, 63% of stocks above their 50-day average. However, a notable pullback today in stocks breaking out to new highs. After that had been really good this last week, both the NYSE and Nasdaq. That came down a bit there today, but still outpacing new lows. We normally get a VIX crush on Friday going into the weekend. However, volatility is definitely perked up this week. There's the 9-day index at 15. Bit of a bounce back and implied correlations as well. Stocks starting to move together again a little bit, but still really low at 10. There's the 2-year government bond yield getting back above 450 after having found support on Wednesday. High yield bonds still hanging in there at this resistance zone though. Still pretty constructive looking at the bond market there. What's really shown strength this week, and something I'll show you a bit later on in this video as well, the best performing stocks this week. A lot of them are related to crypto and Bitcoin. And so the price action we've been getting this last couple of days, markets pulling back, a lot of sectors pulling back as well. It's a good time to look for strength amongst the weakness. Like I say, there's always a bull market out there. And so part of my job for you guys is to identify what's working and what is trending higher. So I'll be coming back to Bitcoin and crypto a bit later on, so make sure you stay tuned in for that. Gold had been performing really well to start this week off. Bit of a sharp pullback there today, rejecting off those all-time highs, which you can see quite often when a market breaks out to all-time highs. It'll quite often come back and retest. Similar story with silver, pulling back a bit this last couple of days as well, along with crude oil and the commodity index as a whole. Maybe getting a little bit oversold here in the short term. However, just looking at the medium-term trend, still a bit soft in the overall commodity complex. A little bit of weakness across international equity markets as well. There's Brazil and China having turned down pretty sharply this week. And mega cap tech still trading pretty heavy. There's Nvidia finishing down near weekly lows. Tesla came off a bit today, 4%, and Apple was pretty much flat, with Microsoft trying to find its footing above $4.30 a share. But as you've probably already heard, the biggest story across markets today was a huge global IT outage caused by cybersecurity firm CrowdStrike. It wasn't a cyber attack. They did an update with a bug in it, and that caused the blue screen of death on Microsoft-run computers around the world. And just goes to show how interconnected the world and all of us are these days. Everything from airlines, banks, retailers, hospitals, 9/11 systems, a lot of things went offline. Companies reverting back to doing things manually, and I even noticed it myself. I couldn't access my bank last night, and I went out to buy some wine, and I wasn't able to use my credit card. Even my local bottle shop was affected by it. Felt like the beginning of a movie, to be honest, and I can imagine as we move more and more into this AI world, these things are going to become more common, and the risk will go up. We saw a lot of grounded flights, disrupted stock exchanges around the world. CrowdStrike's already come out, said they're deeply sorry for this outage. Microsoft's in the spotlight as well, showing a bit of vulnerability with an external company that they partner with, having such a rippling effect across the world. Sure, they'll be looking into this, try and prevent it happening again. And as we just saw, the stock got hammered today, down over 10%. However, according to research out from Bank of America, it's an unfortunate event, but they're not expecting any long-term implications. They said an update's already been pushed out to customers, and CrowdStrike is proactively working to rectify the situation. The impact of this software defect underscores how many enterprises globally rely on and trust CrowdStrike with their security needs, and we believe CrowdStrike will continue to be the security platform of choice given its best-in-class products. They reiterate their buy rating and $400 price target. And I'd have to agree with them. It is an unfortunate event, but at least there wasn't a cyber attack that caused this global outage, in which case their product would be questioned, big loss of confidence amongst all stakeholders. The fact is, it's one of the strongest growing companies out there. Just looking at their subscription revenue, over the last 4 years, it's been growing at a compounded rate above 54%, and the need for cybersecurity is not going anywhere. In fact, it's accelerating. And just looking at that price action, it did look like there was a big buy the dip in today's action. In fact, just going down to a 5-minute chart, we can see even before the market opened in pre-market just after 5 a.m. Eastern Standard Time. The market found its lows around 270, then actually closed above $300 a share. Bank of America still got a target at 400, and it's still got a really big uptrend over the last year, with them consistently beating on earnings expectations as well. But just getting back to the market, we got Wall Street racing to catch up to the market, increasing their price targets for the S&P 500 end of year, after the market had already traded up above the most bullish expectations. Amongst all Wall Street forecasters, just got UBS now raising their price target for the 4th time this year, saying stocks can soar 17% by the end of the year. Saying on the back of favorable market conditions due to profit growth, disinflation, and AI investments, saying the S&P could actually surge 17% to 6,500 by year end, coming out really bullish, looking like they don't want to raise their price target for a 5th time, with them also pointing to the Fed likely to begin cutting rate, given further tailwind to the stock market. However, we do have volatility picking up. Is this just some mid-year seasonality? Maybe the option market starting to price in the election? The events we saw last weekend? Largest global IT tech outage, just adding to it today. Didn't really get much economic data out this week. We are getting some pretty big moves in the market. A lot of people thinking, is this just a little buy the dip, or is this going to turn into a larger correction? So I'm saying there's a really high probability we will get a recession next year, with one economist pointing to a troubling trend in the money supply. Even though he predicted inflation will likely fall below 2%, he still thinks we're going to get a recession because the economy is slowing down, and the growth of money supply has also slowed with it. Some have taken it a step further, said we're in the greatest bubble in human history and it's close to bursting. That's Mark Spitznagel, a bearish investor, predicts stocks may soon lose over half their value in a sell-off. He's also predicting a recession fueled by the government's $34 trillion debt. He's pointing to similarities with the dot-com bubble, but he thinks we're on the way to something really, really bad, but he's been calling for that since January last year. And it's true, we are seeing some moves out there. Looking at the 3-day rate of change for the Nasdaq index, the biggest pullback we've seen since early last year. And even though no indicator is 100% correct, nothing is guaranteed, especially in markets. The best we can do is to try and work out the probabilities, looking at data and historical patterns, because that's all we've really got. And looking at data since 1950, when the S&P 500 has a first half of the year above 15% like this year, typically we will see more gains in the second half, and the full year will average around 25%. So this market could still slap on another 10% between now and end of year, but for sure we could still easily see a 5 to 10% pullback in between then. Analysts are expecting calendar year 2024 earnings growth of 11%, and for calendar year next year they're expecting that to accelerate to 14.7%. But technology companies are richly valued and priced for huge amount of growth. Looking at the forward PE in IT, currently at 30, well above the 10-year average here in the green at 20. And in fact, there's only two sectors where the current forward PE is below the 10-year average, and that's utilities and energy, the lowest forward PE at 12.7. So if energy stocks manage to put in some good growth over the next year or two, we've got a good starting valuation. That expansion and earnings per share and the multiple the market assigns to them, when those two things expand, that's how you get big trends. And considering the likely incoming administration is going to be pro-US energy, oil and gas, that could be a further tailwind energy sector in addition to financials as well. And so we saw this vicious rotation off some extreme levels, which you can often see around tops and bottoms, get a pickup in volatility. And so we just reached the 24-year high of large cap growth versus small cap value, more than 2 standard deviations above the long-term average. Not only that, the Russell 2000 small cap versus the Nasdaq, more than 2 standard deviations from its long-term average. And again, just looking at historical technical signs, when the Russell 2000 increases more than 10% in 5 days, looking back in history, a year later, it's always higher with an average gain of 34%. That's quite bullish if you ask me. Also helping to potentially fuel the outperformance in small caps over the coming years is investors small and large are just not positioned there. In fact, looking at the cumulative flows into US large cap stock funds versus small caps, over the past 4 years, it's pretty much been nothing but large caps, as a lot of investors are conditioned to believe that's how you outperform the market. Even fund managers, we all suffer from recency bias. But even bigger than tech stocks, large cap growth, and their divergence from small caps in value is that of international stocks versus US stocks, with US stocks a whopping 3 standard deviations above the long-term average relationship with global stock. Just been a massive outperformance of US equities this last 15 years, thanks to mega cap tech. And just looking at the Bank of America Global Fund Manager Survey, 100% of fund managers are expecting the Fed to cut in September. 3/4 of them are expecting Trump to take back the White House, and 68% of them are expecting a soft landing over the next 12 months. And whilst we do have some signs of froth in the market, we're not quite there yet across the board. Just looking at 10 signals that we typically see in prior market peaks. Everything from consumer confidence, growth expectations, valuations, yield curve, credit stress, credit conditions. An average of 70% of them will flash in prior market peaks. Currently we're at 50%. So again, not quite there when it comes to red flags of a market peak just yet. And a lot of people forget that secular bull markets can go on for a lot longer than what we expect. We saw that back in the 50s. The market broke out to new all-time highs, went on for 16 years before it went sideways for 14 years, broke out to new all-time highs, did have a little bit of a short-term crash there in 1987, but quickly recovered, had a 20-year bull market. We peaked out in 2000, we went sideways for 13 years, broke out to new all-time highs, and so it's possible we're 11 years in a secular bull market, with the last two lasting 20 years and 16 years. So the average of that is 18 years. If this one went 18 years, that would take us to 2031, which I think would surprise a lot of people if the market kept rallying for another 7 years. And we have been seeing signs of the market starting to run. Just looking at the Goldman Sachs most shorted stocks index, hedge funds typically gang up and short stocks under distress. We saw a huge squeeze with them in COVID. The whole Reddit crowd, meme traders, targeting heavily shorted stocks like GameStop, AMC, squeezed them up like crazy, put in a massive topping formation, fell over hard. Recently we've been signs of that most shorted basket breaking out, showing there is a bit of risk appetite out there in the market. Moving on to other markets, we've got bond yields jumping back this last couple of days. We didn't get much economic data this week. Did get some big moves after last weekend's events. Looked to have pulled back midweek, with stocks pulling back this last few days, along with bond yields bumping back up, and potentially a bit of flight to safety after all these recent events into Bitcoin. I've seen the dollar pull back a bit as well. Gold had just broken out to all-time highs, but just pulled back these last few days with stocks. And since it looks like we're about to get a pro-crypto government take hold in the United States, there could be a bit of a tailwind there, and Bitcoin could be getting excited, with Trump scheduled to speak at a Bitcoin conference next week in Nashville, Tennessee, as he looks to dig his heels in on this topic. And there is speculation out there that Trump could announce Bitcoin as part of a US strategic reserve, which if that did materialize, I would say would be a watershed moment for Bitcoin in the crypto industry, and would likely send it soaring a lot further to new all-time highs, potentially taking it above $100,000 a coin before Christmas. Moving on to commodities, got oil pulling back, and like I said, the commodity complex starting to look a little heavy here on the charts. Apart from gold and silver, still not too far from highs. Crude and other energies, and especially agricultural commodities, are trading in short-term downtrends. However, keep in mind, gold is still a great hedge, especially if we get a recession after the Fed starts cutting rates. Just looking back in history, at the start of a cutting cycle here, 0 months, looking at the performance of gold following the start of a Fed rate cutting cycle. The average performance here in the dark blue, pretty good over the next 12 months. Average about 10-15% gain, then even going out to 18 months and 2 years. We can see some good gains. There is a wide dispersion in those gains. Just looking here in the shaded light blue. You got the 25th and the 75th percentile of gains. Interesting to note, if we don't get a recession here in the red line, performance the following 6 months after a Fed rate cut can be sideways, a bit soft. However, we can still see those gains a year or two later. What's really interesting is if we do get a recession here in the orange line, that first 5-6 months, gold will rip higher from the start of a Fed rate cut if the economy is soft. And that's why it makes for a good hedge in a portfolio. And I'm currently eyeing off more investments in the gold and crypto related space as well, as they make for good diversifiers in a portfolio. And as a trend follower, we want to invest in what's going up in price, along with having some macro tailwinds at our back. Just moving on to the US presidential race, still less than a week. It's the favorite frontrunner. Was almost taken out by 1/4 of an inch. We've now got more than 30 Democratic members of Congress calling on President Joe Biden to step down and exit the race and allow Harris to potentially take his spot. And you know it's bad for Biden when even Hollywood elitists are calling him to step aside, along with huge donors. We've even been hearing from never-Trumpers like Zuckerberg calling his response to the shooting badass. And we've now got popular betting site Polymarket creating a new market, Biden versus lettuce. They're giving it 10 days to see which one is going to last longer. Looking at the current odds, lettuce is just out in front at 53 cents. I'd say that's actually pretty undervalued. And just looking at political betting markets, looks like it's already been decided, and Harris is looking like the front runner for the Democrats. Trump's still out in front at 62%. And I had someone ask me, how do they work out the odds of who the market thinks is going to win? Well, just to give you a quick explanation, a lot of betting sites are different all around the world. Like that one I just showed you in Polymarket, if you bet 53 cents, you'll make $1. However, a lot of betting sites, they'll quote a winner as say like $1.80 or $2. And so when you see that, to work out the probabilities, you just start with 1 divided by the payout. So say the payout in the market was $2, that would be 0.5. So if a betting site was offering a $2 payout, the implied market probability that would happen is 50%. And so Trump at 62%, to reverse engineer that, you can just do 1 divided by 0.62. So the market's probably offering a $1.61 payout, if that all makes sense. Another way to look at it, if a market's offering a $1.50 payout, you start with 1, divide that by 1.5. That means the market is given a 66% probability that event is going to occur if the payout is a $1.50. So Harris had a 19.7% probability. That is 1 divided by 0.197 means she's paying over $5 if she does win the presidential election in November. So like I've been saying for a few weeks, it looks like Biden's on the cusp of dropping out. Just looking back in history, we do have one precedent for that. That was Lyndon Johnson, who withdrew from the 1968 presidential race, even though his withdrawal was a bit more of a surprise than what it will be with Biden. Nonetheless, didn't seem to bother the stock market too much. In fact, it rallied up quite significantly after he withdrew from the race. And like a lot of election years, they finished higher back in 68 as well. Another interesting thing this week is the correlation between the odds of a Trump win and the performance of the Russell 2000 small cap index. And here in the yellow line at the top, there's Trump's odds in the orange line. You can see they jumped up quite a lot there together on Tuesday, and then both kind of just rolled over into the weekend a little bit. So I thought that was a bit interesting. Moving on, we've got more good things coming out of Argentina, now headed up by Milei. Cut the government down to size, cut out agencies, drastically cut spending, privatizing a lot of things. It's only 6 months on the job. It's already got inflation dropping like a rock, and people think you need huge government spending to drive economic growth. Once again, he's proven that wrong, with their economy rebounding, growing 1.3% month over month, led by agriculture. But like he'll tell you, it's still early days. There's still plenty more work to be done. But nonetheless, this is good signs for the long struggling South American economy. Also interesting today, we've got Nvidia taking a $4 million stake in CRWD, a company that focuses on self-driving delivery vehicles for last mile deliveries. Seen Nvidia take a number of small stakes in these small AI and robotic related companies this last year. And CRWD, they're automated delivery boxes and often deliver food orders for delivery platforms like Uber Eats. Other investors in the company include 7-Eleven and Uber. The company's launched its operations in Los Angeles, and its next phase of expansion, they're looking at new deployments in San Diego, Dallas, and Vancouver. And there's a look at the daily price action in this small company, up a whopping 187% today. Still a small market cap, around 100 million. It's got no revenue yet, and it's only got 67 employees. Really small company, but just goes to show there's still plenty of action and appetite in the AI space here, even on weeks like this week. There's the economic calendar for today. Retail sales in the United Kingdom came in really soft, down 1.2% month over month and 0.2% year over year. And that's just nominal. That's not real inflation adjusted. So adjusting for inflation, retail spending in the United Kingdom is definitely contracting, just like it is in Canada. Month over month down 0.8%. And whilst they still increased year over year 1%, it was well below expectations. So a bit of signs of softness in the consumer around the world there. Looking out to next week, we'll get some home sales data on Tuesday. Going into Wednesday, PMIs across the Eurozone, along with manufacturing and services PMIs from the States. Going into Thursday, jobless claims, GDP growth data. US economy is expected to have grown 2% quarter over quarter. Then finishing out with the big one on Friday, the Fed's preferred inflation gauge. Personal consumption expenditures index, with both the core and headline expected to have grown 2.5% year over year. That'll be a big one the market's keen off. See what reaction we get in bond yields and stocks with that. We'll also get into the thick of Q2 earnings. There's a look at the earnings calendar for next week. We're starting off with Verizon. Tuesday, Coca-Cola. Alphabet, Google, the big one, Tesla. Wednesday, IBM, and then a few more large caps and blue chips to finish out the week. Make sure you come back to the Click Capital channel tomorrow. I'll be posting that video that I scheduled to post last weekend before those events unfolded, and I think you'll find this really interesting. Chasing the elusive white unicorn stock. I'm going to talk about the characteristics of 100-bagger stocks. That's stocks that have gone up 100-fold, 10,000%, $1 to $100, and I'll be showing you a few examples of those 100-baggers. Make sure you come back to the Click Capital channel about this time tomorrow and enjoy that video. And just getting back into the charts, like I said at the start of this video, on weeks like this, when the market pulls back, it's good to try and identify the strength and market leaders amongst that weakness. So I've just run a simple screen where I've filtered the universe of US stocks for those with a market cap above $1 billion and traded more than $10 million worth of shares today. Gives us a universe a bit above 2,000 stocks. Then I've ranked them by their weekly performance. So I thought it'd be interesting to show you guys what liquid stocks performed the best this week. Cypher Mining is related to Bitcoin. There's MicroStrategy finishing strong as well. Virtue Financial, they're a market maker, competitor to Citadel. Hut 8, another Bitcoin miner. Same with Marathon and Riot Platforms, up 28% on the week. Aurora Innovation, small cap tech stock, designing and developing automobile hardware and software, trading up. Another utility, New Fortress Energy. Root Finance, technology-driven insurance company, performing well. Coinbase perking up, and a few other Bitcoin miners, along with Lemonade, another tech-driven insurance company. And so apart from Bitcoin-related companies, a few utilities. Overall, just looking at the sectors, remember it was energy, REITs, staples and financials significantly outperforming this week, and tech having broken away, which we can see on the composite chart of the Magnificent Seven. But we're just sitting at the 50-day VWAP. Just technically speaking, the uptrend is still intact, so we shouldn't be writing mega cap tech off here. And I'd say the breakout in small caps is still in play. We're just having a bit of a healthy pullback and retrace. Like I said, we'll be looking for this level here, 210 on the IWN, as a bit of a technical line in the sand for this breakout to be defended, which very well may be tested next week. That's all I've got for you in the daily market review. Thanks very much for tuning in, and don't forget to come back to the channel tomorrow for my special weekend video where we'll be diving into 100-bagger stocks and how to identify them. Thanks very much for tuning in, and I'll see you again tomorrow. Cheers.